Today, we're diving into a really huge shift happening in the world of accounting. It's a new standard called IFRS 18. Now, I know that sounds super technical, but stick with me because it's about to create a whole new blueprint for how companies show us their profits, making everything way clearer and more comparable than it's ever been. So let's just start with a basic question. Are all profits created equal? I mean, if you look at two different companies right now, can you really truly compare their profit numbers side by side and feel confident you're getting the real story? For a very long time, the answer to that has been a pretty definite no. And that, right there, is the problem that IFRS 18 is meant to fix. You see, the old standard, IAS 1, gave companies a ton of flexibility in how they presented their performance. Now, flexibility sounds like a good thing, right? But what it really meant was that one company's operating profit could include totally different things from another's. It just created this landscape where trying to make a simple, direct comparison was almost impossible for investors and analysts. And to get why this is such a big deal, you kind of have to look at the long road that got us here. The first standards were born back in the 70s, but the version we've all been working with, ISIS 1, came about in 2001. And from that point on, for 2 straight decades, it was just amended over and over and over again. You can think of it like an old house that's had room after room just tacked on. By the time we got to the 2020s, it was this complicated patchwork of rules that was just begging for a complete do-over. And so that's what happened. The International Accounting Standards Board, the ISAB, decided that instead of adding yet another patch, it was time to just build a new foundation from the ground up. They really zeroed in on the statement of profit or loss, the part of the financial statements that's supposed to tell the story of a company's performance. And the result of all that work is IFRS 18. So, the most important thing to get here is the fundamental shift in thinking. The old way, under IAS 1, let companies pretty much decide for themselves what subtotals to show. But the new way, with IFRS 18, says nope, everybody has to follow the exact same structure, using the same categories and the same required subtotals. It's a massive move away from creative reporting and toward a single, clear, comparable global standard. Okay, so what does this new foundation actually look like in practice? Well, the single biggest change, the absolute heart of IFRS 18, is a complete redesign of the statement of profit or loss, what a lot of us just call the P&L. And at the center of this new P&L is a brand new, required definition for operating profit or loss. It's now strictly defined as all the income and expenses from a company's main business activities. Basically, it's everything that isn't directly related to investing, financing, taxes, or selling off parts of the business. For the very first time, we have a common definition that everyone has to use. No more guesswork. To make all this happen, IFRS 18 forces everything to be sorted into 5 new mandatory categories. First up is operating. You can think of this as the engine room. It shows the real health of the company's core day-to-day business. Next up is investing, which captures returns from things like investments, keeping them separate from the main operations. Then you have financing, which isolates all the costs and income tied to how the company raises money. And finally, income taxes and discontinued operations get pulled out into their own sections, so there's really nowhere for any weird or unusual items to hide. And this new structure, it's completely non-negotiable. It doesn't matter if you're a tech startup in Silicon Valley or a giant manufacturer in Germany, your profit and loss statement is going to follow this exact blueprint. This creates an incredibly powerful common language for understanding how businesses are performing, no matter the industry or the country. And within that new structure, IFRS 18 also requires 3 specific subtotals that have to be reported by every single company: operating profit or loss before financing and income taxes, and then the final profit or loss. You can think of these as mandatory signposts on the road to the final net income number, making that whole journey a heck of a lot easier for everyone to follow. But IFRS 18 doesn't just stop with restructuring the main statement. Oh no, it also goes after the wild west of so-called adjusted profits. You know what I'm talking about, those custom, made-up numbers that companies love to put at the top of their press releases. The official term for these is Management-Defined Performance Measures, or MPMs. An MPM is any subtotal, like adjusted EBITDA or core earnings, that management uses to try and show their version of the company's performance. But it isn't a number that's actually defined by the accounting standards. Sometimes they can be useful, but let's be honest, they can also be really misleading. Well, IFRS 18 is bringing all of that out into the open. From now on, if a company wants to use one of these MPMs, it has to include a detailed note right there in its official financial statements explaining exactly what it is. They have to tell us why it's useful, show us the calculation, and, this is the big one, they have to provide a full reconciliation that clearly connects their custom number back to the nearest official IFRS number. It basically forces companies to show their math, which makes it super easy to see if an adjusted profit is really just a sneaky way to hide some bad news. So, okay, let's step back from all the technical details for a second and just ask, why does any of this actually matter? What is the real so what here? For investors, for analysts, for you? The payoff, really, it all boils down to three key things. First, we get a massive increase in comparability. We can finally actually compare apples to apples. Second, we get way more transparency, which means companies can't just use their own custom metrics to paper over bad performance. And all of that leads to the third and most important benefit. We can all do better analysis and make more informed decisions, spotting red flags or maybe even hidden gems that used to be buried in all the noise. And you should know, this isn't something that's happening in the distant future. This new standard becomes mandatory for every company on January 1st, 2027. Right now, businesses and auditors all over the world are already working hard to get ready for this huge transition. So I'll just leave you with this thought. For decades, the real story of a company's performance could be hidden behind complexity and custom numbers. IFRS 18 is giving us a new, much clearer lens to look through. The real question now is, with all this new clarity, what hidden stories are financial statements finally going to tell us?